Welcome back to the Crypto Intellect, where we break down the biggest developments in crypto, global markets, and institutional money so you can stay ahead of the crowd. Today's headline is one that XRP and HBAR holders absolutely cannot afford to ignore. Tom Lee has just confirmed a move that is turning heads across the entire crypto industry, and the timing of it may be even more important than the amount itself. While many retail investors were focused on fear, uncertainty, and red candles across the market, some of the biggest institutional players in the world were quietly doing the exact opposite. They were buying, not after prices recovered, not after analysts declared the bottom was in. They moved during the correction itself. That distinction matters because history shows that institutional capital rarely waits for the headlines to turn positive before positioning itself. Instead, it often enters when uncertainty is highest and confidence is at its lowest. What happened over the last several days has created one of the most interesting setups we have seen in this cycle, and for XRP and HBAR investors who have been patiently holding through months of volatility, this could be one of the most important developments of the year. What makes this story so significant is the scale of the capital involved. Tom Lee's company, BitMine, reportedly deployed more than $213 million into crypto during the recent market correction. Think about that for a moment. We are not talking about a hedge fund adding a small allocation or a company making a symbolic investment. We are talking about hundreds of millions of dollars committed during a period when market sentiment was weak, and many investors were questioning where prices could go next. BitMine's entire business model revolves around acquiring cryptocurrency at scale, and according to Tom Lee, that scale is measured in billions. So when a company built specifically around crypto accumulation decides to commit over $213 million during a correction, it naturally attracts attention. Large institutions have access to extensive research teams, macroeconomic analysts, market intelligence, and risk management frameworks that most retail investors simply do not have. That does not mean they are always right, but it does mean their actions deserve careful observation. When they deploy capital during fear, instead of waiting for certainty, it tells us something important about how they are viewing the current market environment. The story becomes even more interesting when we add another major player into the equation. Around the same period, Michael Saylor's company Strategy also expanded its crypto holdings with an additional purchase valued at approximately $98 million. Combined, these two institutional moves represent more than $300 million entering the crypto market during a correction. That is a substantial amount of capital being committed at a time when many investors were worried about further downside. What stands out is not simply the dollar amount, but the sequence of events. These purchases were made during weakness, not after recovery. Historically, many people assume institutional investors wait until fear disappears before making large allocations. Yet once again, we are seeing evidence that sophisticated market participants often operate differently. They are willing to step into uncertainty when valuations become attractive. This is one of the oldest principles in investing. Buy when others are fearful and position ahead of potential recovery, rather than chasing momentum after prices have already moved significantly higher. For long-term crypto investors, this behavior should sound familiar, because some of the strongest market recoveries in history began when sentiment was still overwhelmingly negative. By the time headlines become optimistic, a significant portion of the move has often already happened. Institutions understand this dynamic. They understand that waiting for complete certainty usually comes at a cost. While retail investors often seek confirmation before acting, institutional capital frequently seeks opportunity before confirmation arrives. That appears to be exactly what we are witnessing today. The market remains uncertain, volatility remains elevated, yet major players are deploying capital. This does not guarantee immediate upside, nor does it eliminate risk, but it does provide a valuable insight into how experienced investors are interpreting the current environment. Their willingness to buy into weakness rather than strength suggests that they see long-term value despite short-term volatility. Another important aspect of this story involves Michael Saylor himself. For years, Saylor built a reputation around one simple strategy: accumulate Bitcoin and hold it. His commitment to that philosophy became one of the defining narratives of institutional crypto adoption. Yet recent developments have sparked conversations among market observers because his actions appear more tactical than in previous cycles. Experienced investors closely monitor shifts in behavior from influential market participants because those changes can reveal evolving views about market structure. When someone who has spent years following a highly consistent strategy begins making adjustments, analysts naturally pay attention. It does not necessarily mean the thesis has changed, but it can indicate that the investor sees opportunities developing within the current cycle. Combined with BitMine's aggressive accumulation, these developments have fueled speculation that major institutions may believe the market is approaching a significant turning point. Now let's talk about why this matters specifically for XRP and HBAR holders. Many investors in both assets have endured months of difficult price action. Corrections are never easy, especially when they last longer than expected. During these periods, doubt tends to grow. Friends question your investment decisions. Financial media focuses on negative narratives. Social media becomes dominated by bearish opinions. Maintaining conviction through that environment is challenging. Every red week creates another opportunity for critics to claim that the thesis is broken. Yet experienced investors understand that conviction is often tested most aggressively near important market inflection points. The emotional difficulty of holding through uncertainty is precisely why many people struggle to capture long-term gains. Markets have a way of rewarding patience while simultaneously making patience extremely uncomfortable. One of the technical indicators attracting attention right now is the 200-week simple moving average. This metric is widely respected because it compresses years of price history into a single reference point. Unlike shorter-term indicators that react quickly to daily news and volatility, the 200-week moving average moves slowly and reflects long-term market structure. Historically, when major crypto assets fall below this level, they often enter zones associated with significant bear market lows. It does not predict exact bottoms, but it provides context. Investors who study previous cycles know that some of the strongest opportunities emerged when prices traded near or below this long-term average. The indicator has become an important reference point because it filters out noise and focuses attention on broader market trends rather than short-term emotional reactions. When analysts compare the current setup to previous cycles, 2022 is frequently mentioned. During that period, Bitcoin traded below its 200-week moving average for an extended time before eventually beginning a recovery. Sentiment during that phase was extremely negative. Many investors believed the market would continue falling indefinitely, yet those who maintained a long-term perspective eventually witnessed one of the strongest recoveries in crypto history. XRP displayed similar structural characteristics during that cycle. Today, market observers note that both Bitcoin and XRP are once again interacting with comparable long-term support zones. While no two cycles are identical, historical parallels are attracting attention because institutional buying is occurring at the same time. The combination of technical similarities and significant capital deployment creates a narrative that many investors find difficult to ignore. The reason this comparison resonates with so many long-term investors is that it reflects lived experience rather than theory. Investors who remained committed during previous downturns understand how emotionally challenging those periods were. Fear dominated conversations. Confidence disappeared. Yet those who focused on structure rather than headlines often found themselves in a dramatically different position once recovery began. The lesson many took away from previous cycles was that markets tend to reward preparation rather than reaction. By the time the majority becomes comfortable, the most attractive opportunities are often already behind them. That historical perspective is one reason institutional buying during corrections carries so much significance. It suggests that some sophisticated investors may believe current conditions resemble earlier periods that eventually produce substantial upside. Beyond technical indicators and institutional accumulation, there are also broader global developments that deserve attention. One of the biggest factors influencing markets over the past year has been geopolitical uncertainty. Financial markets generally dislike uncertainty because it makes forecasting future conditions more difficult. When geopolitical tensions rise, investors often shift toward safer assets. Conversely, when tensions begin to ease, risk assets frequently benefit. Recent reports suggesting a reduction in military tensions involving Israel and Iran have attracted attention because they represent a potential decrease in one of the market's most significant uncertainty drivers. Whether these developments continue remains to be seen, but investors are carefully monitoring them because reduced geopolitical stress can create a more favorable environment for growth-oriented and risk-sensitive assets. Interestingly, recent market behavior has shown periods where XRP and HBAR appeared to respond positively when geopolitical risks eased. Correlation does not equal causation, and no single factor determines price action. However, investors often look for patterns across multiple variables rather than relying on one explanation. When geopolitical conditions improve, capital generally becomes more willing to seek higher returns. This can benefit sectors like technology, innovation, and digital assets. The broader point is that market conditions do not exist in isolation. Institutional flows, technical indicators, economic data, and geopolitical developments often interact simultaneously. Understanding how these forces connect can provide a clearer picture than focusing solely on daily price fluctuations. The macroeconomic backdrop is also becoming increasingly important. Inflation expectations have shown signs of moderation, and that matters because inflation directly influences monetary policy. When inflation pressures begin easing, central banks face less pressure to maintain restrictive conditions. Lower inflation expectations can eventually support a more favorable environment for risk assets, including cryptocurrencies. Investors have observed this relationship across multiple economic cycles. Markets tend to respond positively when the outlook for monetary policy becomes less restrictive. Even small improvements in inflation data can influence expectations about future interest rates. These changes may seem minor on the surface, but financial markets often react to direction rather than magnitude. A trend toward lower inflation can become more significant than a single monthly reading. Adding to this narrative are developments in energy markets. Oil prices play a major role in inflation because energy costs affect transportation, manufacturing, logistics, and countless other economic activities. If oil prices continue trending lower, that could further reduce inflationary pressures across the broader economy. Lower inflation strengthens arguments for more accommodative monetary conditions over time. Investors are paying close attention because these macroeconomic shifts often create favorable conditions for assets that benefit from increased liquidity and improved risk appetite. Again, none of this guarantees a particular outcome, but it does contribute to a growing list of factors moving in a direction that many crypto investors view as constructive. Imagine the perspective of a long-term XRP or HBAR holder who has spent years researching blockchain adoption, utility, institutional involvement, and market cycles. That investor has watched prices fluctuate dramatically. They have endured skepticism from friends, negative headlines, and prolonged corrections. Now they are seeing institutions commit hundreds of millions of dollars during weakness. They are watching inflation trends improve. They are observing geopolitical tensions potentially easing. They are hearing increasing discussions about regulatory developments. From their perspective, the environment may appear very different than the narrative being presented by short-term market sentiment. This contrast between institutional behavior and public perception has been one of the defining characteristics of many previous market turning points. Institutional investors often view fear differently than retail participants. Rather than treating fear as a reason to retreat, they frequently view it as information. Extreme pessimism can create opportunities because prices may disconnect from long-term fundamentals. This does not mean every correction should be bought blindly, but it helps explain why large investors sometimes make aggressive moves when confidence is scarce. Their focus tends to be on probabilities, valuation, and long-term outcomes rather than immediate emotional reactions. The recent purchases by BitMine and Strategy fit this pattern remarkably well. They suggest that at least some sophisticated investors see value in current conditions despite the uncertainty that continues to dominate headlines. Another major topic generating excitement is the potential impact of regulatory clarity. Many analysts have highlighted legislation such as the Clarity Act as a possible catalyst for the crypto industry. Regulatory uncertainty has long been one of the biggest obstacles facing digital assets. Institutions generally prefer environments where rules are clearly defined. Greater clarity can reduce risk, encourage participation, and support innovation. For XRP specifically, regulatory developments have always carried outsized importance because of the asset's unique history and its relationship to broader discussions about digital asset classification. If meaningful legislation advances, many investors believe it could become one of the most significant catalysts of the current cycle. What makes the current environment particularly interesting is the possibility that several positive forces are developing simultaneously. Institutional accumulation is increasing, geopolitical uncertainty appears to be easing, inflation trends are becoming more favorable, discussions around regulatory clarity are intensifying. Individually, each factor would be worth monitoring. Together, they create a convergence that naturally attracts attention. Market turning points are often characterized by multiple forces aligning at the same time. That does not mean outcomes are guaranteed, but it does mean investors should pay attention when several important variables begin moving in the same direction. When we step back and look at the bigger picture, the pattern becomes easier to see. More than $300 million has been deployed into crypto by major institutional players during a correction. Long-term technical indicators are reaching levels historically associated with significant cycle opportunities. Macroeconomic conditions are showing signs of improvement. Geopolitical risks may be moderating. Regulatory catalysts remain on the horizon. None of these developments alone guarantees that XRP or HBAR will immediately surge higher. Markets remain unpredictable, and risk is always present. However, the overall structure is beginning to resemble periods that many experienced investors remember well. The thesis that attracted long-term believers to these assets remains intact, and the broader environment appears increasingly supportive of that thesis. As always, this is not financial advice and is provided for educational and informational purposes only. Make sure you conduct your own research before making any investment decisions. But after everything we covered today, one question remains. Which part of this entire picture do you believe is receiving the least attention from mainstream financial media? Is it the institutional buying, the macroeconomic shift, the geopolitical developments, or the potential regulatory catalysts ahead? Let me know in the comments below because I read every single one. If you found value in today's analysis, make sure you like this video, subscribe to the Crypto Intellect, and share it with someone who needs a broader perspective on what is happening across the global crypto landscape. Stay informed, stay patient, stay positioned, and I'll see you in the next one.